They did everything right, every single one of them. They worked their jobs for 30, 40, sometimes 50 years. They filed their tax returns faithfully, year after year. They paid what the government asked of them, promptly, completely, without complaint. They were not hiding anything. They were not running schemes. They were not parking secret fortunes in offshore accounts or routing cash through shell companies in jurisdictions where the American government cannot easily see. They were ordinary, law-abiding retirees. And then, without warning, without any wrongdoing they could identify or explain, they received a letter from the Internal Revenue Service, and their lives, in some cases, were never quite the same again. This is the story that is unfolding right now, in 2026, quietly, without the attention it deserves, in the bank accounts and mailboxes and sleepless nights of Americans who are among the least likely people you would ever expect to find in the crosshairs of federal enforcement. It is a story about a rule that has existed for more than 5 decades, enforced in ways that are entirely new, powered by technology that is as indifferent to human context as a glacier is to the flowers it buries. And it is, above everything else, a story about a gap. The treacherous, invisible gap between what you know about your own financial life and what an algorithm, operating at machine speed, believes it can deduce from the pattern of your transactions. The rule at its center is the Bank Secrecy Act, enacted in 1970, when the Congress of the United States decided that large cash transactions were sufficiently correlated with criminal activity to warrant mandatory federal reporting. The mechanics are, on the surface, straightforward. Anytime you deposit, withdraw, or exchange more than $10,000 in cash in a single business day, your bank is legally required to file a Currency Transaction Report, a CTR, with the Financial Crimes Enforcement Network, which operates under the United States Treasury. The bank does not ask your permission. It does not notify you in advance. It simply files. This has been the law for more than 50 years, and the majority of Americans who have triggered these reports have done so in perfect innocence, without ever knowing the report was filed, and without any consequence whatsoever. A contractor who receives a cash payment for a kitchen renovation, a small business owner who makes a weekly deposit from a strong week of sales, a retiree who withdraws cash for a home repair. The report gets filed. It lands in a federal database. And historically, for the vast majority of people, it simply sat there, reviewed by no one, connected to nothing, gathering the digital equivalent of dust. But here is the sentence that changes everything, and it is the sentence that almost no one has heard. That era is over. What replaced it is something categorically different in its reach, its speed, and its consequences for people who have not the slightest awareness that they have done anything worth examining. In 2026, the IRS, an agency that has simultaneously undergone significant workforce reductions, having shed roughly a quarter of its staff over the past year, has deployed artificial intelligence systems that do what a reduced human workforce never could. They process everything, they cross-reference everything, and they flag anomalies at a scale and velocity that no team of human auditors could approach. As one detailed analysis published in January 2026 by a national accounting and tax advisory firm noted, the IRS now uses AI in both the selection of returns for audit and in the conduct of the audit itself, with systems specifically built to identify high-risk patterns among large corporations, complex partnerships, high-net-worth individuals, and users of digital assets. But the blast radius of these systems does not stop at the wealthy and the sophisticated. It extends, with complete mechanical impartiality, to anyone whose financial transactions look, to an algorithm, inconsistent with what their tax return says they earn. Consider what that means in concrete human terms. A 72-year-old widow, living on her pension and Social Security, inherits life insurance proceeds from her late husband, perhaps $200,000 kept in savings, already counted in her estate and known to the government. She decides to help her daughter through a difficult divorce, transferring $40,000. The IRS system sees the transfer. It compares it against her reported income of, say, $72,000 for the year. The machine asks a single question: does this match? And because the machine has no access to the emotional architecture of her decision, no awareness of the life insurance policy documented in a probate file it has not examined, no understanding of what a mother does for a child in crisis, the answer the machine generates is, no, this does not match. Flag it. And then the letter comes. Or consider a 71-year-old retired contractor who sells a rental property. The buyer pays $150,000 in cash, a legitimate arm's-length real estate transaction, the kind that occurs in this country thousands of times every day. He deposits the money, The bank files a currency transaction report, as it is required to do. The IRS system cross-references that deposit against his most recently filed tax return. But the amended return, the one that properly reports the sale, has not yet been submitted. There is, in the machine's view, a $150,000 discrepancy between what it sees in his bank account and what his return says he received. It does not know the amended return is forthcoming. It does not wait. It flags. And now he is defending himself from a question he should never have had to answer. Not because he did anything wrong, but because the documentation arrived in a different sequence than the machine expected. These are not hypotheticals constructed for dramatic effect. These are the kinds of situations that tax professionals across the country are now navigating with regularity, because the technology has outpaced the public's understanding of how aggressively it operates. And the people most vulnerable to this gap are not, as one might initially assume, the careless or the cavalier. They are frequently the most conscientious. Retirees who handle their finances personally, who deal in cash because they were taught to, who make large transactions infrequently and therefore have no established pattern of large transaction documentation to fall back on when the system comes calling. There is a second dimension to this story, one that is, if anything, more counterintuitive and more dangerous than the first. It concerns a federal crime so poorly understood by the general public that a Treasury Inspector General audit of IRS enforcement reached a finding that should stop every American cold. 91% of the investigations it examined, in cases where the source of funds could be determined, involved businesses and individuals whose money was obtained entirely legally. Not criminals, not drug traffickers, not money launderers. Ordinary people, professionals, business owners, retirees, who were pursued under one of the most paradoxical statutes in the federal criminal code, the anti-structuring law. And what they did to invite that pursuit was, in many cases, something they believed was prudent, responsible, or simply convenient. They broke up their cash transactions into amounts under $10,000. And that act alone, regardless of where the money came from, regardless of whether they ever intended to evade a single dollar in taxes, constituted a federal felony. Stay with this, because what follows is the part of this story that most people never hear until it is far too late to do anything about it. And it is the part where the numbers and the stakes become impossible to ignore. The legal doctrine known as structuring is, by any honest accounting, one of the most counterintuitive provisions in the entirety of the American legal code. It is a rule that criminalizes a behavior most people would describe as cautious, or private, or simply none of anyone's business, and it does so with a severity that bears no intuitive relationship to the harm, if any, that the behavior causes. Understanding it is not optional for anyone who handles significant amounts of cash, at any age, under any circumstances. Because the machines now searching for it never sleep, never take holidays, and have no mechanism for extending to you the benefit of the doubt that any reasonable human being would grant in 30 seconds of conversation. Here is the statute in its essence. Under 31 U.S.C. Section 5324, the Bank Secrecy Act's anti-structuring provision, it is a federal crime to deliberately break up a cash transaction into smaller amounts for the specific purpose of avoiding the $10,000 currency transaction report threshold. If you have $30,000 in cash and you make 3 deposits of $9,999 each, spread across 3 separate weeks, and your intent in doing so was to stay beneath the reporting threshold, you have committed a federal felony. The criminal penalties are not theoretical. For structured transactions involving less than $100,000 over a 12-month period, the exposure is up to 5 years in federal prison and fines of up to $250,000. For amounts exceeding $100,000, or when structuring is connected to another crime, those numbers double, to 10 years in prison and $500,000 in fines. And beyond the criminal penalties, there is civil asset forfeiture, the government's authority to seize the funds involved in the structured transactions, not as a consequence of conviction, but as a civil proceeding against the property itself, initiated before any criminal charge is filed, and requiring you to fight to recover your own money through an administrative process that can consume months. The aspect of this law that must be stated with absolute clarity, because it is so starkly at odds with how most people understand American criminal law, is this. The government does not need to prove that your money came from illegal activity. It does not need to prove that you intended to evade taxes. It does not need to prove you were hiding income, defrauding creditors, or engaged in any underlying crime whatsoever. It only needs to prove one thing, that you deliberately structured your transactions to avoid triggering the reporting requirement. The source of the funds is irrelevant. The presence or absence of any tax violation is irrelevant. The intent to evade the report is the crime. Everything else is beside the point. And here is the dimension of this that has attracted congressional attention and genuine bipartisan concern. In 1994, Congress removed the requirement that prosecutors prove you knew structuring was illegal. Under the law as it currently stands, you can be convicted of this federal crime without ever having been told it existed. You can be pursued, investigated, and have your funds seized on the basis of a pattern of deposits that you arranged out of privacy preferences, personal habit, or a simple misunderstanding of how the system works, and your ignorance of the law provides you no protection whatsoever. A bipartisan report from the House Committee on Ways and Means, examining IRS structuring enforcement, urged the IRS and the Department of Justice to review their cases and return wrongfully seized assets to people who had been swept up in enforcement actions targeting behavior that had nothing to do with criminal proceeds. The committee's findings were, in its own language, eye-opening. The overwhelming majority of people pursued under the structuring statute, in the sample it examined, were not criminals. They were people who preferred to handle their banking in a particular way. In 2026, the AI systems now deployed by the IRS have been specifically programmed to detect structuring patterns. These algorithms look for accounts where the owner has made multiple sub-$10,000 transactions that, in aggregate, suggest an attempt to remain beneath the reporting threshold. They cross-reference activity across multiple accounts at different financial institutions. They analyze sequences. They assign risk scores. And they do all of this continuously, automatically, without the kind of contextual judgment that a human investigator would bring to the same set of facts. Banks are simultaneously required to file suspicious activity reports, SARs, when they themselves detect what appears to be structuring behavior, even when no single transaction exceeds $10,000. Once a SAR is filed, it can trigger an investigation by IRS Criminal Investigation, the Financial Crimes Enforcement Network, or both. The machinery, once set in motion, is difficult to stop and expensive to navigate, even when the person at its center has done nothing that any reasonable person would call wrong. Now here is where I want you to understand something important, something that changes the emotional valence of everything you have just heard. This system, for all its severity, is not actually designed to catch you. It was designed to catch tax evaders, money launderers, drug traffickers, people moving illicit proceeds through the banking system in ways that are genuinely destructive. The problem, and it is a significant one, is that automated systems operating at this scale cannot distinguish, without human review, between a retiree making modest cash withdrawals for home repairs and a criminal deliberately fragmenting transactions to obscure illegal income. The pattern can look identical from the outside, and until human judgment enters the process, which it eventually does in the form of an IRS agent reviewing the flagged case, the system treats both with the same initial suspicion. The people who navigate this environment successfully are not the ones who happen to avoid triggering the system. They are the ones who, when the system is triggered, can answer its questions completely, immediately, and with documentation. That is the distinction that matters. Not whether you get flagged. In an era of AI-driven pattern recognition, an increasing number of innocent people will be. But whether, when the letter arrives, you can close the gap between what the system suspects and what actually happened. And closing that gap requires preparation that most people have not made, because most people have not been told they need to make it. If you know someone, a parent, a neighbor, a friend navigating retirement, who handles any significant amount of cash and has no idea the system exists, what happens next is something they need to hear. Share this, because the information in the final part of this story is the difference between preparation and penalty, between confidence and crisis, between walking into an IRS inquiry with your documentation in hand and walking into it with nothing but the honest truth, which, by itself, in an automated enforcement environment, is often not enough. There is a phrase that legal professionals who work in this space use with quiet regularity, and it deserves to be engraved somewhere visible in the financial planning of every American who handles cash in meaningful amounts. The phrase is this: the trigger is not the transaction. The trigger is the gap. It is a distinction of immense practical importance because it reframes the entire question of what you need to protect yourself from. The $10,000 threshold, the filing of a currency transaction report, the fact of a large withdrawal or deposit, none of these things, standing alone, will get you into serious trouble with the Internal Revenue Service. The CTR is filed, it lands in the federal database, and under ordinary circumstances, That is the end of the interaction. What transforms a reported transaction into an enforcement problem is when the system looks at what it sees in your bank account and cannot reconcile it with what it sees on your tax return. That gap between the observable financial activity and the documented explanation for it is where the danger lives. Close the gap, and the risk diminishes dramatically. Leave the gap open, and you are dependent on the goodwill of an automated system that was not designed to extend any. So what does closing the gap actually require? It requires first an understanding of what the IRS's AI systems are actually asking when they examine your financial activity. The core question, reduced to its simplest form, is this: does this transaction make sense given everything else we know about this person's financial life? If you made $78,000 last year from your pension and Social Security, and your bank records show a $45,000 cash deposit, the system wants to know where that $45,000 came from. If you have documentation showing it came from the sale of a vehicle, or from savings you accumulated over years, or from an inheritance, or from a gift, documented, organized, accessible, you can answer that question definitively. If you cannot, you are at the mercy of a process that assumes the worst until you can prove otherwise. The documentation required is genuinely not complicated. It is the kind of paperwork that a methodical person, given 30 minutes in a filing folder, can assemble for almost any major financial transaction in their life. If you withdraw significant cash for home repairs, keep the contractor's invoice. Keep the receipt showing work was completed. Keep photographs of the finished work if you have them. If your adult children give you money, as a gift, for your birthday, to help with medical expenses, ask them to write a brief, dated, signed letter stating exactly what the transfer was, how much it was, and that it was a gift with no expectation of repayment. That letter, which takes 5 minutes to write, is worth more in an IRS inquiry than any amount of verbal explanation. If you receive an inheritance, preserve the will, the executor's statement, and the bank documentation showing the transfer. If you sell property or any significant asset, retain the bill of sale. If you move money between your own accounts at different institutions, keep the bank statements that show the funds originated from your own holdings. These are not exotic requirements. Most people have fragments of this documentation already, scattered across filing cabinets and email inboxes and kitchen drawers. The discipline required is not in creating the documentation, it is in keeping it organized and accessible so that, if the question ever comes, the answer is not a frantic search through years of paper. A simple accordion file, organized by year and by category of transaction, accomplishes the same function as a system that a sophisticated business would pay a professional to maintain. The goal is not perfection. The goal is a paper trail capable of answering one fundamental question: where did this money come from, and what was it used for? The second layer of protection involves your tax return, and this is where the connection between documentation and filing becomes most direct. Your tax return is the primary document against which the IRS's automated systems will compare your financial activity. If your return is incomplete, inaccurate, or delayed, it creates precisely the kind of gap that triggers scrutiny. If you sell a property and the amended return reporting that sale has not yet been filed when the deposit hits your account, you have a discrepancy in the system that you will eventually need to explain. The solution is not complicated, but it requires intentionality. File your return promptly, file it completely, and make sure that major transactions, sales of assets, inheritances received, large gifts, significant transfers, are reflected accurately and without gaps. The IRS's AI systems are specifically built to cross-reference bank activity against return data, give them nothing to question. The third protective layer is the one that most people overlook entirely, because it requires doing something before a problem arises, and human beings are, as a general rule, not inclined to seek professional guidance until they are already in difficulty. That instinct is understandable, and in many areas of life it is entirely rational. In this particular area, it is costly. If you are planning to make a large cash transaction, a significant withdrawal, a major deposit, a substantial transfer between family members, a brief conversation with a tax professional before you make it is worth a multiple of whatever it costs. Not because the transaction is necessarily complicated, but because the professional can tell you what documentation you should have in place, how to structure the transaction in a way that minimizes ambiguity, and what your tax return should reflect as a result. That conversation also creates a record of its own. Evidence that you sought guidance, that you were acting in good faith, and that your approach to a potentially scrutinized transaction was deliberate and transparent rather than evasive. There is one more thing to be said, and it is perhaps the most important thing of all. The IRS's enforcement systems, the AI-driven pattern recognition, the currency transaction reports, the suspicious activity reports filed by banks, are not, at their core, aimed at you. They were designed for a different category of person entirely: the deliberate tax evader, the criminal laundering illegal proceeds, the fraudster hiding income in patterns of cash activity constructed to deceive. The overwhelming majority of retirees, of honest working Americans, of people navigating the ordinary financial complexity of a long life. They are collateral to the system's primary purpose. The problem is that collateral exposure in an automated enforcement environment can produce consequences that feel indistinguishable from targeted prosecution. The letter from the IRS looks the same regardless of whether the algorithm that generated it was right or wrong. The burden of responding to it falls equally on the guilty and the innocent, and the cost of navigating it, in time, in stress, in professional fees, is real whether or not a single penalty is ever assessed. The protection, then, is not about being invisible to the system. In 2026, that is no longer possible for anyone who handles cash above the reporting threshold. The protection is about being explicable to the system, about ensuring that the gap between what the algorithm sees and what your life actually looks like is narrow enough to close quickly, completely, and with confidence. Keep your receipts. Write your gift letters. File your returns accurately and on time. Deposit what you have when you have it, without strategically timing your withdrawals to stay beneath a threshold. Talk to a professional before a major transaction. And if a letter ever arrives, engage with it promptly and with documentation in hand, rather than with explanations and goodwill alone. Now, tell me something in the comments. Has this happened to you or someone you know? Have you ever received an IRS inquiry about a transaction you knew was entirely legitimate? Because the stories that need to be told about this system are not in congressional testimony or legal journals. They are in the lived experience of people who had no idea this was possible until it happened to them. Leave your story below, and if this information reached you before a problem rather than after, share it with someone for whom that remains possible. Because the difference between knowing and not knowing, in this particular corner of the law, is a difference worth every minute you just spent here. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in.